In the world of pattern trading, we're always looking for ways to maximize the velocity of every single dollar. And for years now, one of the biggest complaints from retail option sellers was something called dead money. That's cash sitting idle as collateral. But as of this year, the game has changed. I can't believe I missed this one until now. Stay tuned. You definitely want to stick around with me on this one. Hey folks, Tom Gentile here, America's #1 pattern trader. Welcome back to Patterns and Profits. Got something new for you this time. In making money on collateralized capital, and if you're a Robinhood customer, pay attention. Remember, any strategy I talk about here, there's no guarantees, and this isn't investment advice. And of course, past performance isn't indicative of future results. Now, back in January, Robinhood officially rolled out interest on options collateral. This means the money you set aside for your cash-covered puts or credit spreads is no longer just sitting there. It's now working for you, earning high-yield interest while the trade is live. Now, keep in mind, before this, there were only a very few select brokerage firms out there that offered this extra cash bump on options collateral. Now, let's talk about how this ties directly into my Patterns and Profits cash flow strategy. When we use the money calendar to identify high probability seasonal windows, we aren't just looking for direction. We're looking for a return on capital. And many times we'll buy calls, or perhaps we'll buy call spreads. But by selling premium on these new opportunities, we're now effectively double dipping. Think about it. You're collecting immediate premium from the option buyer. That's your first win. But now you're also capturing the daily interest on the collateral required for that trade. Now, to understand how the impact looks for your cash flow strategy, we have to look at something called yield on yield math. As of April 2026, Robinhood's gold high yield cash rate is around 3.35% APY. While the rate's variable based on the Fed funds rate, it turns dead collateral into secondary income, which is a new income stream for you and I. Here's a breakdown of how much extra cash and extra cash flow you would generate on $10,000 of collateral over a 30-day money calendar window. Looking at this table, here's why that extra $27.53 is a strategic game changer. Number one, you're boosting the alpha. Even at a higher premium target, that passive interest still adds a 6.8% boost to your trade's bottom line. You're essentially getting paid to wait for the seasonal pattern to resolve itself. Number two, offsetting something called slippage. In high velocity trades, you might lose a few dollars to the bid-ask spread. All right, the interest earned on your collateral often covers that cost entirely, ensuring that your net profit stays closer to your gross target. And number three, compounding the money calendar edge. If you execute this successful every month, your annual return isn't just 48% or $4,800. It's closer to 51.3%, which is $5,130 when you factor in the compounded interest. That is an extra 3.3% in pure profit with zero additional market exposure. All in all, it effectively lowers your break-even point and eliminates the opportunity cost of being locked into a trade. Whether we're running the wheel or executing targeted credit spreads, your money is now moving in two directions at once, capturing the seasonal pattern and harvesting the interest. And that's how you trade with edge. That's how you put the profit into Patterns and Profits. Again, if you like this video, subscribe, share it with others. I'm Tom Gentile. Let's get to work.